Hello, everybody. Thank you for joining me today. I'm John Eade. I'm the president of Argus Research Group. We are a New York-based Wall Street research firm providing forecasts and outlooks for the global economy and global stocks to investors around the world. As I talked to investors recently, a lot of them have been paying much attention to the US markets, which have shot off to all-time highs already here in 2021, even as corporate earnings have not been coming in very strong. So the concern among investors is the US preparing for a correction in the stock market that could actually turn back into a bear market? We don't think the risk is that high, and we'll talk about it now over the next few minutes. I'd like to go to my first slide, which is titled Bulls and Bears. The top two charts give a graphical presentation of the bull markets since World War II and the bear markets since 1960. The bull markets on average since World War II have seen stocks rise about 160% over 5 years. So they tend to last a long time. In this current bull market, which is less than a year old, stocks have already risen 80%. So a very quick start. But I'll point out that we had a very quick bear market, the last bear market, that lasted only a month from February to March 2020, and stocks fell 33%. So the market is moving faster here. Moving on to some of the fundamentals, I've got a couple of charts on this slide about market valuations. The first chart is on stock price valuations, and the blue line you can see is above the red fair value line. So stocks are a bit overvalued here. Not as overvalued as they've been prior to other bear markets, but they're not undervalued either. However, if we look at the fourth and final chart on this page, it's a chart of the valuation of the US benchmark 10-year Treasury bond. And bonds are very overvalued here. Interest rates are historically low, and that really offsets the somewhat high stock market valuation. And so we're still favoring stocks. All right, let's move on to the next slide. And this one's titled US GDP. We'll talk briefly about some of the positive fundamentals behind stocks right now. That includes economic growth, which is normalizing here in the US and is expected to grow 3 to 4% over the next 2 years after sharp swings in 2020. We see the unemployment rate chart in the upper right is coming back down from a high of 14% last April and May. It's down to around 6% now. We expect it to fall close to 4% over the next couple of years. So that should be a positive tailwind for the consumer sector of the economy. And we looking at consumer confidence here on one of these charts. Consumer confidence fell sharply last year, hasn't completely recovered. So that's a lot of bullishness that we think that consumers can recover as the unemployment rate declines, supporting consumer spending, supporting the US economy, supporting corporate profits. Meanwhile, on our last chart here, we're looking at the federal funds rate. This is the Federal Reserve keeping interest rates very low for investors at the long and short end. And with those rates low, you get the bond yields with the higher valuations. And again, that drives people towards stocks, a further support for a positive outlook for the stock market. There are some risks. And on our last slide, we'll look at the risk environment. We've got inflation as a risk. Although most inflation measures are below 2%, we've got oil prices starting to rise, but those are likely to be capped by peak oil and still sluggish demand. And we also have global GDP growth, which is likely to be uneven and could hurt exporters here in the US. In all, though, we think those risks are going to be managed and overcome by good US GDP growth, as well as low interest rates. So if there is a correction in the US market, we expect it to be short and a buying opportunity for US investors for quality stocks. Thank you very much.